Hi guys, Lucas Rogers speaking from the Rogers Property Group. Thanks for joining me this afternoon. Guys, today I've had a question, well, a lot of tax questions coming in at the moment, but I've had one come in from a client talking about or asking me to talk about what is a non-cash tax deduction. Now that sounds quite technical, a non-cash tax deduction, but what it really is fairly simple. Now, with normal tax deductions, what we're doing is we have to spend money to get the tax deduction. So, for instance, an interest repayment or a insurance repayment or even property management fees. What we're doing is we're spending $1, and then what we get back at the end of the year from the ATO is the amount of tax involved with that dollar, or the amount of tax associated to that spending. So if we've spent, say, $1,000 on an insurance policy, and my tax rate is 30%, well, I can anticipate at the end of the year that I'm going to get $300 back from that expenditure, which is pretty good. Now, that's a cash deduction where we're spending money to get the tax deduction. Now, what's a non-cash deduction? Well, it's exactly that. It's where we're not having to spend any money in order for us to get the tax deduction. It almost sounds too good to be true, doesn't it? It's like almost like a false tax deduction. It's a book entry. Why that is so good is because you don't have to outlay any money and you're still getting the cash back. So for instance, examples, or the best example that I can give you of a non-cash tax deduction is of course depreciation. Now, because the cost of construction has gone up, houses have gone up, there's more fixtures and fittings in them, you can get up to $40,000 in your fixtures and fittings at the moment, and just on a basic investment property. Now, you might be entitled to depreciation on those fixtures and fittings and plus the construction of close to $10,000. Now, that's $10,000 that you're not actually outlaying. It's just part of the capital expenditure of the property. But what the ATO enables you to do is to write that off over a period of time. And thus, it's what we call a non-cash tax deduction. So you might be entitled to $10,000 as a tax deduction, even more than that, actually $20,000 I've seen in recent times, from depreciation expense. Now, if you're on a taxable income of say 40 cents in the dollar, well, if you're spending, or if you've got a tax deduction from depreciation of $10,000, well, you can expect to get $4,000 back in cash at the end of the year. If you've got $20,000 worth of depreciation expense, which as I said is quite common these days, well, that means you're going to get $8,000 back at the end of the year. It's a significant amount at the end of the day, and it makes a huge difference to the cash flows for your property, because you're not actually shelling out for that expense, you're just getting that tax deduction from a book entry. $8,000 has a huge impact on our cash flows for the year. So guys, really pay attention to what types of deductions that you're expecting from your property. Look for those non-cash tax deductions. As I said, depreciation being a good one. And especially if you're on a high taxable income, your non-cash tax deductions like depreciation, or tax deductions for that matter, are very important to you. What they say is 75% of your cash flow from your property comes from your rent. The other 25% is going to come from your tax savings. So guys, if you have any further questions, please feel free to call the office, email me personally, and I'll address those in later videos. Guys, take care and happy investing.